Welcome to World Prism. Please subscribe and hit the bell icon for more breaking updates. In the spring of 2025, Hamburg's usually bustling port fell eerily silent. Cranes stood idle, container ships vanished, and the hum of global commerce faded. This was the shockwave of a trade war between the United States and China, felt thousands of miles away. A shipment of American machinery, bound for Shanghai, was rerouted. Tariffs made its delivery impossible. The disruption was more than numbers on a spreadsheet. It was a break in the world's supply chain. The escalating conflict, triggered by the US imposing 145% tariffs on Chinese goods and China retaliating with 125% on American imports, brought trade between the two giants to a near standstill. The flow of everything from electronics to soybeans slowed to a trickle, throwing global supply chains into chaos. For Germany, this was a wake-up call. The silence in Hamburg was a stark reminder of the nation's vulnerability. Germany's prosperity, built on exports, depends on stable global trade. The US-China conflict threatened that foundation. The era of predictable alliances and trade rules was over. Germany now faced a volatile, new reality. Navigating this turmoil would be essential for Germany's future. The US-China trade war trapped $660 billion in goods and services in a web of tariffs, more than the annual output of Switzerland. Tariffs of 145% and 125% weren't just punitive. They were designed to halt trade entirely. Global markets reeled. Stock exchanges from New York to Tokyo swung wildly with every new announcement. Oil prices and commodity markets fluctuated on rumors, not fundamentals. Uncertainty became the new normal. When a 90-day truce was announced in May 2025, markets soared in relief. The US dropped tariffs to 30%, China to 10%. But the truce was fragile. The core disputes, intellectual property, market access, tech supremacy, remained unresolved. For Germany, the lesson was clear. Relying on a single dominant partner like the US was now a risky bet. The $660 billion tremor forced German leaders to rethink their economic strategy. The old order was shaken. Diversification was no longer optional. Germany had to look beyond traditional alliances to secure its future. The world's financial health had become hostage to this bilateral conflict. The aftershocks would reshape Germany's global outlook. Germany's economic engine is exports, cars, machinery, chemicals, all stamped, made in Germany. The US-China trade war struck at the heart of this model, threatening sales in both key markets. Tariffs and uncertainty made Chinese factories hesitant to buy German equipment, and American consumers wary of luxury imports. More damaging, global supply chains unraveled. German manufacturing relies on components from dozens of countries, many from Asia. When those links broke, entire production lines stalled. The volatility of 2025 exposed Germany's vulnerability to external shocks. The old reliance on stable transatlantic ties was no longer enough. Diversification became a necessity, not a choice. German leaders began searching for new reliable markets to anchor their export-driven economy. Increasingly, their focus shifted eastward. After the trade war's chaos, stability became Germany's most valuable currency. The US, once the guarantor of global order, now seemed unpredictable, its policies shifting with each election. German industry needed a partner offering long-term predictability. China, with its 5-year plans and consistent economic strategy, emerged as a pragmatic alternative. German CEOs saw the appeal of a partner that plans in decades, not quarters. The calculation was stark: risk the volatility of a traditional ally, or engage with a stable, if challenging, authoritarian partner. The 90-day truce only underscored the fragility of the US-led order. For German companies, hedging bets and building new pillars of stability became essential. Protecting jobs and prosperity now meant forging new partnerships, even if it meant uncomfortable choices. China's market is simply too big to ignore. Over 1.4 billion people and a booming middle class. For German firms, China is the future, the main source of growth for cars, chemicals, and more. Demand for high-quality German products is insatiable, pulling German interests eastward. China's policy stability is another draw. While Western democracies face political swings, Beijing offers long-term economic planning. When China targets a sector like electric vehicles, it creates massive, predictable demand. China is no longer just the world's factory. It's a leader in innovation and R&D. For German companies, this means both competition and opportunity for collaboration. The pivot to China is a calculation of national interest, not shared values. Germany's economic well-being now depends on access to China's market and stable supply chains. In a world of uncertainty, China offers scale, growth, and a measure of predictability. The power of China's market is undeniable. Hollywood's Zootopia 2 grossed $500 million in China alone, nearly half its global total. For global companies, success in China can make or break profitability. German automakers like Volkswagen and BMW now rely on China for up to 40% of their sales. Profits from China fund R&D and the shift to electric vehicles. German firms are designing products specifically for Chinese consumers and building factories, research centers, and design studios in China. This is not offshoring for cheap labor, it's onshoring to be close to customers and partners. Deep integration with China insulates German companies from future supply chain shocks. China's consumer power gives Beijing leverage. Access is a reward, exclusion a punishment. For Germany, continued access to China is a top priority. Economic reality compels Berlin to maintain a stable relationship with Beijing, despite inevitable disagreements. The stakes are too high for ideology to override pragmatism. Germany's pivot to China signals a potential realignment of the global economic order. As Europe's economic leader, Germany's choices shape the entire EU's direction. Europe now faces a balancing act, historic ties with the US versus economic necessity with China. The future will be one of selective partnerships, security with the US, economic engagement with China. A closer German-Chinese axis could create a powerful Eurasian trading bloc, challenging transatlantic dominance. New standards for technology and trade may emerge, influenced by Berlin and Beijing as much as Washington. The world is moving toward multiple economic centers, not a single US-led system. Germany's response is pragmatic, seeking stability and opportunity in the East, not abandoning the West. Strategic autonomy is the goal, building resilience for Germany and Europe. In a turbulent world, Germany is charting a new course, guided by necessity, not nostalgia.